how to screen details, how to fine-tune. And I have a pleasure to announce the moderator of the panel, Mr. Charles S. Sidman, Managing Partner of ECS Capital Partners, United States. Welcome. Kevin Hin, Secretary General, JCI Monaco. Kevin, welcome. A dear friend of mine, Michael Gold, with his best title so far, Architect and co-implementator of the Kosovo Credit Guarantee Fund. And also a dear friend of mine, Rina Ibrahim, co-founder of Ficus Venture Capital from Malaysia. I know that we will have the best answers to these critical questions. Ladies and gentlemen, the floor is yours.
I assume we have the half hour. Is that correct? Yes. Okay. Good.
An hour and a half, did you say? An hour and a half? 2 hours.
Okay. Oh, welcome everybody. This, I think, is a very important topic that we're going to talk about now. Bybars tells me that 1,400 entrepreneurs applied to participate in this meeting, and 100 were invited to come present. There's a lot of hopeful entrepreneurs out there, and they are the engine of economic development and advance. But they need some resources. They need the investors. And the topic of our session is encapsulated in the first 2 sentences of the description. I just thought I would read them. Entrepreneurs may want funding, but do they deserve it? At the end of the day, that will be up to the investors that back them or not. So our panel is going to consider this question, how to facilitate and improve the success rate of the entrepreneurs and investors interaction. And it's a very well-chosen panel, I think. I did not select the participants, but we have several people speaking primarily to the entrepreneur side and several people speaking primarily from the investor side. So we should have a good conversation about how to improve this interaction. So what I'd like to do is first ask my colleagues here on the stage to introduce themselves, where they come from, what they do, not necessarily yet address the question. I will go last among the 4, and then I'm going to pose some questions to particular groups of panelists. So, Michael, why don't you start introducing yourself?
Hi, it's great to be here. Michael Gold, Managing Director, Crimson Capital, also Chairman of Crimson Finance Funds. We have 3 funds in 3 different countries that invest. And we also do a lot to support accelerators, incubators, and innovation centers.
Good morning. My name's Kevin Hin. I'm the Secretary General of JCI Monaco. It's a non-government JCI, which is the Junior Chamber International. So I'm a bit under the weather right now. I'm based in Monaco, but our headquarters are based in St. Louis, Missouri, in the USA. Our organization is an NGO which, with about 150,000 members around the world in 120 countries. Our members are primarily young leaders and entrepreneurs aged 18 to 40, and our goal is to turn them into strong leaders for a changing world, which means we give them development opportunities in business education, entrepreneurship education, leadership, international cooperation, and community values in order to become great leaders who can then take positions that change the world. So I'm honored to explain how we're going to help that link entrepreneurs and investors later on. Thank you.
Good afternoon, everyone. My name is Rina from Malaysia, but I've spent the last 23 years in Singapore, so I have the best of both worlds. So most people ask me, what do you do? So at heart, I'm still an entrepreneur. I love building business. I had the opportunity to list 2 of the businesses that I built. So I have the freedom to invest. Have been investing since 2006 from Singapore. Invested in more than 100 over startups, see them grow, died of natural death, and we repeat the same thing again. I also am a co-founder of a venture fund out of Malaysia. It's a first Sharia compliant VC fund that will be launching. And I'm very happy to be here because I really wanted to look at opportunities in the European countries, primarily Latin America and also Africa. So very happy to actually have my colleagues here to share insights. I think all of us are still learning from each other, and that should be the way. Thank you.
Okay, and so to complete the introductions, my name is Charlie Sidman. I spent most of my life as an academic, discovering and then trying to apply first computer science information and then biomedical research information. During that application process, I learned about angel investing and I began to do it. And for the last 10 years, that's all I've done, investing. I invest as an angel, as a fund manager. I've been a crowdfunding advocate, Wall Street, public markets, etc., all focused on young, growing, exciting companies. So that's who we are up on the stage, and we expect to get contributions, questions, and insights from the audience as well. So I'd like to start out asking two of our panelists, speaking primarily from about the entrepreneurial side of the entrepreneur-investor interaction. How do you advise and train entrepreneurs to be more successful at this interaction, to get good investor partners and resources? So, Michael, maybe we could start with you.
Thank you very much. It's interesting to me when I hear at these kind of events about how we have to start with 1,000 ideas and then win them down to 100, etc., and then maybe invest in 10 or whatever it is. I look at it from the point of view of screening potential entrepreneurs, and we work with entrepreneurs. We both invest in entrepreneurs, but we also have programs, venture academies and accelerators and incubators to help entrepreneurs. And I think what we don't do enough of is the initial screening, where there's so many ideas and enthusiastic young people or even older potential or existing entrepreneurs. But the problem is there should be, in my view, there should be an immediate first pass review. Is there a commercially viable business here? If you ask that question, the answer is often no, right off the bat. And yet, a lot of us spend a huge amount of time, working with these entrepreneurs, having them write, these huge, long business plans, doing all these things. And there isn't inherently a business to start with. It might be a great idea, exciting, it sounds sexy and everything, but there's not a business. So what we counsel all entrepreneurs is, before you go too far to develop, the MVP, and before you go in to do this, and before you spend all this money, actually, with the concept of your product or service, or the prototype, or whatever stage you're at, actually go out and talk to potential customers and see if you deliver a product or service that you think you can deliver. Does anybody want it, and will they pay for it? If you don't do that as an entrepreneur, you're wasting time, and ultimately investors are not, if they don't see that there's a market interest in it or for it, they're not going to do it. And the other thing is I advise them, for their financial projections, don't just pull them out of their you know what. Okay? Most entrepreneurs, they do their financial projections, and unfortunately there are a lot of advisors and programs and business support centers that teach entrepreneurs to do this, because those people have never run a business or made payroll themselves. And what they do is they say, oh, for this product, it's in this segment, and the global market for that is 62 billion, and by 2025 it'll be 110 billion. I only need 0.01% of that to be successful. So their fifth year on their projection for their revenues is they just take a random small percentage of the global market, and then they straight line back. And the first thing I always ask is, okay, So, yeah, in 5 years, you're going to sell 243,542 units. Who's going to buy the first one? Okay? So, the projection should be based not on what some theoretical market is or what somebody else is doing, but with your product and service and your energy and your salesmanship and everything else. How many are you going to sell, but to and to whom? So the financial projections should be based on the market. So that needs to be, people need to look at, entrepreneurs look at the market. And if I see they haven't done that, I say, well, go do that and then come back and then we can talk. Thanks.
Yes, of course. Thank you for this opportunity. So I was preparing this topic, and I saw that the issue is all about attitude to entrepreneurial investment, and that links to a conversation I was having yesterday with one of the WBAF senators from Nigeria, who was telling me that she had invested in some companies, and all they were asking her as a business angel was, when am I get the next funding? When's the money coming in? When do I get the bank transfer? And she's like, well, no. First of all, I need to know about what your plan is concretely, and what your goals are, and how we're going to do them. My bank, no. So she pulled out in the end. That was unfortunate, a big waste of time for everyone. And when I talk about this topic is attitude, I always believe that it's your attitude that determines your altitude, and it's this kind of attitude and education which we need to inculcate into future entrepreneurs as well. It's all a question of education. They need to understand. They're looking for potential clients. Your first client is your investor who's coming in. So that's one of the first things we need to educate people about. Lots of entrepreneurs have good ideas. They've got an idea. Some of them actually have the business nous as well, but they also need the commercial side. And the most successful entrepreneurs are the ones who combine the idea, the creativity, the business nous, but also the commercial aspects as well, and how to sell their product, and which is what Michael was saying, like having a commercial strategy as well. So this is something which we need to address. For example, at JCI, I was mentioning, we try to build young leaders for tomorrow. That comes from bridging the gap between entrepreneurs and their future clients and investors as well. It's we organise business plan contests where the Monaco government provides €61,000 in grants to anybody who wants to open a business, who is aged 18 to 40 and who wants to create a business in Monaco. So it goes through pitching and all that sort of thing. But before we actually get projects onto jury in front of the Monaco government and with a whole group of investors, we actually go through the screening process as well. And to do that, we have training courses, something which we call the Monaco Entrepreneurship Campus, which is learning how to pitch, learning how to create your business plan, learning how to create your commercial strategy and creating your minimum viable product. And that is done with government officials, with professionals in the field. And this is what I'm saying that because I really believe that entrepreneurial education is something which is essential to be able to avoid incomprehensions and waste of time in the future. So I'll be happy to elaborate on this furthermore afterwards if you have any questions. Thank you.
Excellent. Some very good points, and I agree completely with my two colleagues. Now we're going to change perspectives a little bit, and I will ask Rina, and then I will participate as well. From the investor side, what do you look for to make you write a check or get involved in a relationship? And what are some of the mistakes that you see people make that if they did things differently, the system would work better? So, Rina.
I'm going to address from two sides. One from the angel investment perspective, and also the VC head. For an angel investment is really about the relationship, about the people. So I run an accelerator in Malaysia as well, and some other countries like in Philippines. And the reason why I do that is because over the years, over 20 years of investing, I've seen accelerators or entrepreneurship academies all teaching about technical skills, how to do a great presentation and whole, how to do projection and all this. We all know that these, you can hire people to do it. Your mentors can do it for you, and you practice it 1,000 times before you present to us. So even if it is the best projection, it still depends on the person or the team driving it. So if you're not fit and you're not aggressive enough, or you can't handle a Ferrari, it's no point giving you a Ferrari. So you're better off with an e-scooter. I think, as an investor, as an angel investor, I personally have my own sort of soft spot for a certain industry, particularly in, of course, helping women in education sector, because I believe education is probably the most logical way to solve poverty. If we give education to kids, to marginalized community, we do something good. So my soft spot, if it is education, I will make sure I listened. If it is fancy e-commerce where it is also a me too, although they promise a unicorn, I'll just pass. Personally, for startups who pitch to angel investors, I would encourage them to really go all out to get to know the investor. Stalk the investors if you need to. Check their LinkedIn, because if you come to me and say, "Hey, I've got a good idea," it's all about you. I want to look at investment opportunities that is synergistic to my belief and my portfolio. So if you know that I love education, you have a better chance. And please don't come to their pitching telling the investors what we already know. You know that we actually look at pitches like hundreds of them. So if you have a projection, my question to you would be very simple. Tell me how you arrive at that number, because it's very simple. Don't tell me like my colleague said, start the presentation with, this is a $3 billion industry. I usually skip those slides. Secondly, I think we need to teach these startups, young or more mature founders, about being human. I think the psychology part of it is really important. Be grateful, be thankful. Some of them, because I think they thought they had a great idea, and therefore all of us need to invest in them. It's not that way, because we have choices as well. From a VC perspective, it's important to also understand how the VC mindset works. We raise money from LPs, and we have a responsibility to return the hurdle rate, or the promise of return, and usually it's between like 20-22%. And we have a fund life. So you have really no chance if you come to us when our fund life is at the fourth year, where we are divesting. We're not investing anymore. So be smart, because I talked to some of the startups. They're not aware of how VC works, and we don't invest in ideas. But we do look at who are the angel investors that have invested in you. So most of the angel investors, startups, most of the startups, when they pitch to us as VCs, we look at who are your funders, who are the who's who in the market that believe in you first. And lastly, this is probably the industry trick. I don't believe in coincidence. I don't believe in startups going to a pitch and suddenly, someone is interested to invest in you. You got to do a lot of homework. That separates one startup that's going to be the winner, and those who just live it up to fate. Because I believe 99% is hard work, and if you choose to be there, I think then you probably have the better chance to grab the opportunities. Yeah. So that's my perspective, being an angel investor as well as a VC. Yeah. Charles.
Excellent. I'm going to try to build on and summarize agree with some of the points that were made. It's an excellent presentation. So one thing, I also am an angel and I'm also a fund manager, and my fund, by the way, is evergreen, so we don't have some of the same constraints. Uh, my biggest problem is when an entrepreneur comes to me with their idea or concept or telling me about themselves only, and that's all very interesting. It's important, but as an investor, I have my own passions and preferences, just the way Rina was saying, um, and I am looking for a return. That's an exit. So besides the size of the revenue or the opportunity, as Michael was saying, I want to know, well, who's ready to actually purchase the good or service that you're telling me is so wonderful? And I'm particularly interested in the end point. Why do you think you can build a business of a certain size in a certain time? And if it's just a shot in the dark, it's not going to get very far. It will form the basis of the conversation, and that conversation will tell me a lot about the entrepreneur. Um, so I'm interested in not the idea or the concept. I want a business and an asset value and a return. And so remember, I think as either Michael or Kevin said, the investor is really the first customer. You have to get inside. You have to get to know us. And Rina said this also. You have to get to know us, and you have to sell us on your concept. Not just tell us about yourself, but get inside and try to sell us on what you're offering. Um, and then together, we can, if we do business, we will form a team. We will be part of your endeavor and support you with everything we have. So to go back to the topic of the session, 1,400 applications here. Are all of those going to achieve funding and partnership? I don't think so. It's hard for me to estimate how many of them have the potential to reach it, but I think in most cases, it's they haven't done the homework, which my colleagues have laid out. It's not rocket science. It's eminently learnable, teachable, coachable. Um, do the work necessary and give it your best shot. So I would now like to move into some discussion phase. We don't have a lot of time. And first, I want to give the audience, that side of the room, the opportunity to challenge, ask questions, etc., to any of us. And then if we answer all of your questions, then we will take the baton back. So any
Higher rate of return. Good morning. Normally, investor look for high rate of return of the value which he's investing. Normally, what are the rates which could be attractive as an average for what's running on nowadays for the investors? What are the rate of return which is attractive? Thank you.
I think it really depends. For angel investors, the average return in even in very mature economy like US is like 2.5 to 3x. So if you put $10,000, you'd be very lucky to get that. But as we know, is a when you're an angel investor, you invest at very low valuation, which means there's a lot of risk. So I would encourage angel investors to build a portfolio. It's not like you invest in one company and you strike lottery. You gotta have a portfolio to be able to actually get that average return. But from a VC perspective, we basically look at we invest when we pay a premium, but those companies are already at growth stage. They have revenue, they have proven their concept, but our return, our promise to our investors or LPs or institutional investors is that at least we'll make them 20 to 22% return. So it really depends on the individual investors. If you are angel investors, like myself, for certain industries, I don't look at monetary return. I look at the impact. I look at how I can, with me supporting these particular startup, how they can use their platform, their service, or their product to elevate a community, for example. So it's very much as an individual investor, you have to really know what's your appetite, what makes you happy besides financial gain, right, Charles?
Yeah, only briefly because I think Rina's reply was very complete, and I can't give you a different number. That's not the goal. What I want to say is that I totally subscribe with what you were saying about the values in the project, and even if we're not looking at financial return at JCI, what we're trying to do is develop positive change and impact in the communities, for example using sustainable development goals and trying to make the world a better place. And touching on what you mentioned earlier, education is a key factor into promoting economic growth, which is then also a key factor to promoting peace and prosperity. There are very few countries in the world which have a good economy which are at war. So this is why we believe in the values of education and just investment with values and with a heart in general as well. So that's all I had to add onto that question.
It's a very good question that I think all of us who are also investors get. And the answer, when I was in business school and we had one of the foremost experts on accounting give a lecture, one of the students, and we were all experienced, asked a question, and I was shocked that the speaker said, in accounting, the answer is, it depends. And I thought, well, accounting, wait, you add up the numbers, right? Okay, so the answer is it depends. And I think my colleagues have really said it. And this is where, from the entrepreneur side, I'll speak from the entrepreneur side, what you've heard here is very important. You have to do your homework. You have to understand who the potential financer, whether it's debt or equity, angel, venture, you really have to look and see who they are and what they're interested in, what their motivations are, because that'll make a big difference. So an investor that's looking primarily from a financial return point of view will have a different perspective than an investor who is part of this ecosystem and is working long-term to build the ecosystem as well as make some specific investments. It'll also depend on the risk, as was mentioned, the stage of the investment. So the return can actually be very different depending on what your product or service is, your team, your ability to deliver on the commercial side of it, and then also who is the investor. And as was said very clearly, you need to know who they are so that you can better be able to make a match.
And let me just put some numbers from my perspective at the high end, the sort of formula that I've experienced in the circles I travel in, we won't consider an investment that it's not reasonable to achieve a 10x return in 5 years. Now that translates into 60+% per year IRR. That's a pretty audacious target. In fact, we don't usually get that, but it's a hurdle for us to consider an investment. In fact, in the US and in Canada and in Europe, well-developed early stage ecosystems, the overall success rate for early stage investment is in the high 20s, so 25 to 30% IRR. It's not so much the fold return, it's the IRR which is important. So it's half of the targeted desired hurdle rate of 60+%, but it's still pretty good. And it's a little higher than the VC average because it's earlier and riskier.
I hope I'll not be annoying you to say the figures which I hear from our beautiful Nuh is so aggressive and so high, which doesn't, bring alternative way of thinking from the entrepreneur to go to angel investors while he's having some other access of banks who never, pay such figures. Thank you.
Well, it it's aggressive, but that's the reality of because investors have choices and they will have opportunities that have the potential to achieve those returns. And if they are accepting and investing at a lower expected rate of return, they're doing it not for financial reasons, but for philanthropic reasons, really. And that's legitimate. You just have to know who you're talking to and what their appetite is.
Um, I certainly understand your point. And there are, of course, a lot of entrepreneurs and businesses that are not going to have the growth that's going to result in these potential returns. That's just reality. But that's where, for example, in my master class yesterday about mobilizing, getting banks to be more progressive through things like guarantee schemes can be helpful. There are a lot of wonderful businesses, but they're not suitable for angel investment or venture capital. That doesn't mean they're a bad business. They're just not going to grow at a kind of rate that can justify the risk that the investors are taking. But there are other sources of money. Yes, banks are conservative for many reasons, and it can be hard to get the money. But we can't just focus on equity when we're looking at the entire spectrum of businesses, because in fact, in the United States, less than 1% of any startups get any external financing. Less than 2% of all of the almost 20 million businesses in the US get an equity investment in a given year. Most businesses finance themselves or they get debt, okay? So we have to look at the whole spectrum. And in some cases, when a business has big growth potential, the potential of giving the investor 60% return is fine, because the entrepreneur is going to make a heck of a lot of money and grow a big business. So it really depends. But we really have to look, and part of this is the education, that we need to educate not only the entrepreneurs and the investors, but we have to also educate all of ourselves on alternative financing mechanisms, which will be appropriate for those businesses who won't be able to get equity investment.
Well, this is a really interesting topic. We can continue for the rest of the day. Thank you all for your participation and attendance.